PHH Biological Technology, NASDAQ, PHH Investment Research Report, Executive Summary and Investment. Thesis Core Business Overview. PHH Biological Technology is a Chinese skincare and beauty consumer company that develops and sells skincare products under its PHH and Jinni brands. The business operates via direct product sales and franchise models. It provides light beauty experience services in both directly operated and franchise stores. The company went public on NASDAQ in December 2024, ticker PHH, after executing an IPO that raised approximately $4.8 million United States dollars. Investment recommendation: 12-month view. Hold speculative bull case. High gross margins in product business. Revenue growth has been positive in recent trailing periods. Franchise model allows relatively low capital intensity for expansion. Directly operated stores are few, so growth largely via franchisees reduces CapEx burden. The nascent public market exposure may help with capital access, visibility, and scaling brand awareness. Bear case: operating expenses, SG&A especially, are large relative to revenue, leading to operating losses or thin profits. Very small absolute revenue base. Sensitivity to any drop in sales or increased competition is high. Risks around compliance with NASDAQ listing rules: minimum bid price. Market cap, potential dilution, regulatory and brand risk in China's cosmetics and skincare sector. Scale and brand strength are still developing. Customer loyalty and product differentiation may be weak compared with larger incumbents. Business overview: operations and key products, services, skincare products, including items for anti-aging, exfoliation, and repairing microecological balance of skin. Light beauty experience services offered in stores as a value add. Sales via two segments: 1. Product sales, and 2. Franchise services, business segments, and geography. Main geography: China. Business operates through directly owned stores, very few, plus many franchises. Product sales to non-franchise stores and to franchisees themselves. For their inventory: primary markets, customers, middle-class beauty, and personal care consumers in China. Franchise partners and store operators. Industry and competitive positioning: industry landscape. The Chinese beauty skincare market is large and has historically seen strong growth. Highly competitive with significant regulatory oversight, safety, ingredients, advertising. Consumer preferences shift quickly. Digital and e-commerce channels are increasingly important. Growth drivers: rising incomes and increasing consumer interest in skincare and beauty treatments. Demand for premium and differentiated products. In-store beauty experience may enhance engagement. Potential to develop proprietary products, patents, and reduce costs by controlling ingredients. Headwinds: regulatory risks in cosmetics, ingredient approvals, safety claims. Competition from both domestic and international brands with stronger recognition. Cost inflation for raw materials and potential supply chain disruptions. Franchise model risks: franchisee retention, quality control, and customer experience consistency. Competitive moat and peers. Current moat is shallow. Small scale, new brand, limited directly operated stores. Advantage: franchise model for low-cost expansion, high gross margins in product sales. Peers: larger Chinese and global skincare, beauty brands with more established R&D, branding, and omni-channel distribution. Financial analysis. Key financials: USD millions, approximate. Metric: FY 2022, FY 2023, FY 2024, TTM, latest notes. Revenue: 1.9 to 2.46, 2.38, 2.77. Strong growth. 2021 gives 2022. DIP 2023 gives 2024. Recovery: TTM revenue growth: YoY plus 106%, plus 28%, minus 3.1%, plus 42.7%. Volatile. Tied to few stores products: COGS 0.51, 0.31, 0.20, 0.16. COGS declined as revenue rose, boosting margins. Gross profit: 1.41, 2.15, 2.19, 2.19, 2.61. Gross margin consistently very high. Operating expenses 1.210, 0.97, 1.18 SG, and a volatile, occasionally spiking operating income loss, minus 0.50 plus 0.20 plus 0.79, positive but small. Net income minus 0.49 plus 0.19 plus 0.48. Small absolute profit margins and metrics, gross margin 90 to 95%. Extremely high due to low product cost base. Operating margin, small positive in FY 2024, negative in prior years. Net margin, modest positive in FY 2023 to 2024. Financial health debt to equity, very low, negligible debt tilde. MEST D7 OK versus 1.5 million United States dollars equity. Current ratio, approximately 1.8 strong liquidity position. Free cash flow, positive in FY 2024, tilde 0.87 million United. Efficiency, row modestly positive. Set turnover low given small scale. Valuation metric PHH. Latest industry peer range commentary, PE trailing. Approximately 9.7 mid-teens, 234 established peers, low multiple reflects risk and scale issues. Forward PE, not meaningful, typically growth-based estimates, highly sensitive to small profit base. EV/EBITDA, positive in FY 2024, 10 to 20 common for beauty peers, volatile at small scale, PS tilde. Low market cap. Revenue, 2 to 8 for beauty peers, likely below peer averages. P, be approximately 1 times or less often 2 to 5 times. For branded players reflects weak brand strength and risks dividend yield none. Many larger peers pay dividends not applicable at this stage. Valuation rationale. PHH trades cheaply on trailing PE due to small profitability. However, risks, small revenue scale, and compliance concerns suppress investor confidence. Risk assessment, key risks. NASDAQ listing. Compliance notices received for non-compliance with minimum bid price and market value requirements. Risk of delisting. Scale risk, very small revenue base, vulnerable to demand shifts. Expense volatility, SG&A swings, especially share-based compensation, can erode profits. Competition and brand. Larger players dominate consumer attention. PHH must spend heavily to build recognition. Regulatory risk, ingredient approval, labeling, and franchise rules in China. Liquidity and capital access. Low cash reserves may necessitate equity raises, risking dilution. Upcoming catalysts maintaining NASDAQ compliance, expanding franchise network and store count. New product launches or patent developments, sustained revenue growth and margin improvements, better SG&A control. Conclusion recommendation. Hold speculative bias. Top supporting points. Achieved modest profitability. Trailing revenue shows growth, extremely high gross margins. Low debt levels reduce financial risk. Crucial risks to monitor. NASDAQ compliance, bid price, market cap. Ability to scale revenue while containing costs. Competition from larger brands. Regulatory oversight in China's cosmetics industry. Dependence on consumer discretionary spending. Note: this report reflects publicly available information as of mid-2025. Financials and stock performance may have changed. Investors should confirm all data with the latest SEC filings and official company disclosures before making investment decisions.